If you follow these 8 specific rules, you are going to make more money than index, I can assure you. Hi everyone, so take a look at this chart, and this shows the entire stock market journey of Mr. Ramdev Agrawal, who is considered to be a legendary investor in India. What you would notice is something very interesting, that on 3 occasions his portfolio has been crushed by 50% or more. So let me point that out, and there is a very important lesson here. You can see it that during the 92-93 crisis, his stock portfolio went down by 66%. Here in 2000 crisis, when it was the dot-com bubble burst, his portfolio got crushed by roughly 70%. Then came the 2008 crisis, his portfolio got crushed by 50%. Here we are not talking about individual stocks. Here we are talking about the portfolio of one of the legendary investors in India. So what is the lesson here? The lesson is fairly simple, that as normal retail investors, all of us want to become like Mr. Warren Buffett, Ramdev Agrawal, Vijay Kedia ji, etc. But we do not have the stomach or patience to handle the volatility. This is one of the basic things that we miss about the stock market. So as I'm shooting this video on 10th of November, the stock market fell by 1%. I started getting a lot of panicked messages that should I sell all my stocks now? Should I re-enter later? Please listen to this video. I will explain the entire story in 8 really simple points. If you go and execute these 8 simple points, you are going to make better returns than index. And also, if you're a viewer of this channel and getting value out of it, do press the like button and subscribe to this channel. It will help with the channel's growth. And let us kickstart the video. So the first key point that you must understand about the stock market is that the stocks do not give returns in a straight line fashion. Many a times we imagine that, hey, we are purchasing ITC today or Hindustan Unilever today, and from tomorrow it will start going up. Wrong. It doesn't happen that way. Similarly, when we purchase index, then what do we imagine? We simply imagine that, you know what, index has been given roughly 12.5% return on yearly basis for the last 20 years. So I have purchased this in 2022. By 2023, I should be able to see 12.5% profit on whatever I am buying today. It again does not work in that way. Here is a very important data point that you should look more closely. And what you would see is that if we track the last 20-year performance of Nifty 50, you will see that, hey, that there have been some years when there has been negative returns. For example, in 2000, 2001, negative 15%, then again next year, negative 16%. You will lose faith, or at most you will just say that, okay, you know what, so much loss has already happened. Let me just stay put. So you would have made 3.25% gain. So 3 years gone, you are sitting in negative. You will lose faith and you will move on to other asset classes. But what would happen? You would miss this massive gain that happened afterwards. So the point is that whether it is Nifty, the entire market, or individual stocks, they will never go up in straight line. They will never go down in straight lines. There will be years when you will make 3 years worth of gain, and there will be years when you will lose 3 or 4 years worth of gain. So now the reason why we can't predict which years will be good or which years will be bad, or which months will be good, which months will be bad, is fairly simple, because the market gives asymmetric gains on certain investment days. For example, again, here is a quick data for you, which is a very interesting data piece, that the 10 best days in the stock market from 2002 to 2022 have been these 10 days. You can go through the list and look at the gains that the market has given on singular days. Now, this data point is very important to understand, because as per a research, if you would have invested $10,000 in S&P 500 and you would have held that position, it would have become $61,000. But if you would have missed these best 10 days, then your gain would have been crushed by half. So the half of the return for the entire stock market in the last 20 years has come from just 10 trading days. You can't guess what those trading days would be. There is absolutely zero way you could predict that. Advanced users or advanced investors in the stock market, they do not predict what the stock market is going to do. They stay mostly invested, because by staying mostly invested, they are able to take advantage of asymmetric gains that the market gives on certain days that you and I or anyone else can't predict. Now, in case you are looking to make some sensible investments in the Indian market right now, I've created a series of small cases. These are absolutely free. You can check those links in the description box and on the pinned comment. So go check it out. It's absolutely free of cost. Now, the second key bad habit that we cultivate as retail investors is that we keep on looking for multi-bagger stocks. There are Telegram groups that you would join. You will pay paid services for that. There are advisors you will seek help from who will say that, you know what, pay me like 200 rupees. Then I will tell you 5 multibaggers. All that is nonsense. Please unsubscribe from all those type of groups. You can't predict multibaggers. No one can. One of the most talked about multibagger story is that of Mr. Rakesh Jhunjhunwala and Titan. Mr. Rakesh Jhunjhunwala purchased that stock somewhere around 2002 for 35 odd rupees, and he continued to hold that stock year on year. But here is a quick data point for you that during this entire course from 2002 to up until 2022, there were periods when he sold Titan 2. So it's not as if that he just purchased and forgot about the stock. Yes, net he continued to hold his position on Titan, but it was not as if that Mr. Jhunjhunwala knew that Titan is going to become multi-bagger. If that were the case, then why would he sell even 1 unit of Titan? So what you need to understand about Titan are these few critical points. So first and foremost point is that no one can predict what a multi-bagger is. What people or good investors typically do is that they pick a small company, they continue to reevaluate it, and let's say that it goes from this size to this size, they will continue to hold it. They might book a little bit of profits the way Mr. Rakesh Jhunjhunwala did with Titan. Then they will keep on analyzing this business on periodic basis, and the size of this company keeps going up, and it one day becomes multi-bagger. But sitting in 2022, estimating that by 2042 this company will become multi-bagger, that company will become multi-bagger. Let me purchase 200 rupee membership from this falana person. He will tell me about multi-bagger stock pick. No, please don't do that nonsense. You can't pick multi-baggers via that strategy. All you can simply do is that you can continue to monitor businesses at every stage of growth and then make a call whether you would want to stay invested in that stock or not. I present fundamental analysis, business analysis of different stocks on my paid member community. I'm not selling any multi-baggers. I'm helping you understand businesses fundamentally. That is the utility of that membership. In case you think that that is useful, you could consider taking it. But yes, please do business analysis, please do fundamental analysis, and please periodically revise your thesis or investment thesis in specific stocks. Now, the third thing that novice investors continue to do is that they keep on tracking the price movement and they determine whether the stock price is good or bad as per the price sentiment. You can't identify anything just by the price of an asset. ITC is a classic case in point. I have been an investor in ITC. I have booked very good profits in ITC and I have completely exited the stock. Does it mean that you should also do it? I don't know, but I'm very happy with my ITC investment because I made a lot of money on it. Now, if you go back 6-8 months back, there were people giving a lot of gyan that, you know what, ITC has stopped, this person has sold ITC, this fund has sold ITC, ITC is a dead stock, there is no growth left, taxation implication will be there, falana dheemka. No, nothing happened. ITC gave a run up. Why? Because ITC was a fundamentally good stock. There was nothing fundamentally off about ITC, and in the last 6 months, it has given 40% gain. I can at least give you 20 such examples from my videos where these type of theories have played out. It's not as if that I know more than what other people know. It is just that I'm willing to hold good assets till the time they start giving returns. The reason or fundamental reason behind that is that even if you're the biggest investor in the world, you will not be able to time the market or figure out anything from the prices. One of the key examples there is of Mr. Warren Buffett. So for example, here is Mr. Warren Buffett's entire portfolio, and what you would notice is that this range has almost stayed consistent. What does it show you? That Mr. Warren Buffett does not keep pulling out money every now and then trying to time the market, that okay, now the market is going to go up, I'm going to pour in insane amount of money. Now the market is going to come down, let me pour in less money. He does not do that. You can see how stable his portfolio has been over the last few years. So my theory around this is that when it comes to big investors, it's not as if that they keep on withdrawing, adding more money, etc., etc. What they typically do is that they create a portfolio, they keep it intact. If they are getting additional money, then they figure out whether to deploy that more money at that stage in time or not. And second is that they rotate their capital. For example, in the previous graph where I showed you Mr. Warren Buffett's portfolio, he has rotated it, but hardly ever he would pull out insane amount of money out of the market. So this brings me to the fourth point, that when it comes to good investors, they always have more money to invest. So name 4 or 5 biggest investors that you know of. For example, Mr. Ray Dalio, Mr. Warren Buffett, Mr. Rakesh Jhunjhunwala, etc., etc. All of them are entrepreneurs. For example, Mr. Radhakrishnan Dhamani is a stock market investor, but he is an entrepreneur first who runs DMart. He has money to invest. Whatever money he is making from business, he invests it in the stock market. Same goes for Mr. Ramdev Agrawal. He manages a mutual fund house. Same goes for Mr. Warren Buffett. He is managing an investment portfolio. In many of the companies that he buys, he takes a controlling stake. So he controls that company one way or the other by using money. So the point I'm trying to drive home is fairly simple, that all these legendary investors, they have some other source of income or some major source of income which they then pour into the stock market. One of the core goals of my channel is to help you create multiple income streams, and I keep on speaking that please learn how to create multiple income stream, experiment with new ideas, learn how to build businesses. Precisely because of this point, there are zero legendary investors who depend entirely on the stock market. The fifth trait that good investors have is that they acknowledge their fault and change it fairly quickly. For example, here is a snippet from Mr. Ramdev Agrawal on his investment going wrong with Zomato. Now, if you read the commentary, you will get a sense that Mr. Ramdev Agrawal purchased Zomato at a fairly high price. And he said that, you know what, I was wrong about purchasing it at an incorrect price. Same goes for legendary investors like Mr. Warren Buffett. If he is incorrect about certain things, he will say it out loud. He was incorrect holding a lot of cash during the 2020 end, and he made a mistake of not investing in the stock market when the stock markets gave massive return. I'm not trying to confuse you. As per my previous point, Mr. Buffett maintained his positions on the stocks. He did not cut it, but whatever additional money he was bringing on the table, he decided not to invest in the stock market because he felt that the markets are overvalued. Then after a while, he realized that he is making a mistake and he started taking more positions in the market. So it is fairly normal for your viewpoint to change if the business world is changing. You need to understand the basic fact that whenever you are purchasing a stock, you are buying a business. The nature of that business would change. The price of that business would change. And so should your commentary if the prices have fallen for any business quite aggressively, but you think that that stock is good, then you could consider building some positions in it. For example, I was not very pro TCS when it was trading at its all-time high. I started aggregating TCS when it fell to roughly 3000 levels. Similarly, I was very pro ITC when it was trading at roughly 200 rupees. I purchased it at somewhere around 190, 200 rupees and I kept it and sold it off at somewhere around 270, 280. Have I missed the complete gains on ITC? Yes. But have I made a decent amount of money on ITC? Yes. There are times when I get greedy. For example, when the steel stocks were doing fairly badly, I purchased some of it, held my position, did not sell it on time, then I had to sell some of it on loss. So I've exited my positions in those stocks and I vowed that, hey, I made a mistake by investing in these public sector metals company and I'm not going to build any more positions in it. Similarly, if you're confused about some industries, for example, right now I'm confused about the EV space. I had built a little bit of position in a stock like Amara Raja batteries. I have not built up my position after that. Why? Because I don't know how soon the adoption of EV is going to become mainstream. I still don't see that happening very fast. So I'm not taking any position in it. Once I'm confident that, you know what, okay, EV space is going to blow up in India, I'm okay purchasing stuff at slightly higher prices also. Important thing that you need to do as an investor is that you need to be honest with yourself. If you have made a mistake somewhere, it's fine, just change that. If you're unsure about things, watch it from the sidelines. You don't need to take positions in it. You don't need to defend the purchases that you have made, and you also need to understand that out of 10 bets that you are going to make in the stock markets, at least 4 or 5 will get wrong. The sixth trait of a good investor is that they don't buy and forget, they buy and monitor. So please take a look at this chart for Reliance, and what you would notice is that from a time period 2009 to almost 2018, Reliance gave 0% returns. Reliance being one of the biggest companies on earth, you would have said that, you know what, okay, one of the biggest companies in India, I'm going to put my money in 2008, buy and forget, good company, this, that. You would have lost a lot of money because theoretically in 10 years, as per rule of 72, where you take 72 divided by the return that you are making, even FDs would roughly double your money. But people lost insane amount of money. Why? Because you know what, people tell us that buy and forget. So please don't buy and forget. Please buy and monitor that stock. It's not as if that you need to analyze it on every single day, but wherever you see opportunities coming, you must rotate your capital towards that. If you see something going wrong with that stock, it's okay to sell that stock and come out of it. So please be sensible. So here is a commentary by Mr. Ray Dalio. Initially, he was very averse to cryptos. He considered the entire idea to be toxic. Then he started investing a little bit of money. Now his firm is bringing in institutional money in cryptos. Now, is it a push from my side that you should also go and follow Mr. Ray Dalio? No. I'm just explaining you whatever the facts are there. And it's not as if that Mr. Dalio is going to buy cryptos and forget about it. He's going to continue to monitor it. If you're buying any stock, be it Hindustan Unilever, be it Zomato, etc., you need to monitor monitor it, or at least have a perspective as to why you are getting into that asset. If you join some random Telegram group that, hey, we'll tell you multibaggers, and you listen to that multibagger, buy it, now you don't know what to do with it. So please don't get into these type of traps. So this brings us to the next related point, that people panic in the stock market because they don't understand what they are buying and why are they buying it. I keep on getting so many messages that, Akshat, you know what, you were wrong about like this asset class, or you were wrong about like UiPath, etc., etc. Do you know how UiPath stock is supposed to function? It is a highly volatile company. It is a 0 to 1 type of a venture. It is almost like investing in a startup. Now, if you don't know these basic facts, that hey, when you're investing in a startup or when you're investing in a highly volatile tech asset or a tech company, it is supposed to fluctuate. It can go down in value by roughly 95% and it can come back up. I keep on talking about that example of Amazon, that in 2002, Amazon lost roughly 95% of its value. Then it went back up by roughly 560 times. I'm not talking about percent. I'm saying 560 times. So if you're looking to identify a company that could have Amazon-like potential, then you need to take that volatility also into the mix. So if you don't understand that, you know what, that investing in Zomato is going to be volatile from this point, or investing in XYZ company is going to be volatile, don't invest in it. Invest in things that you understand. Let me give you another example. So 7-8 months back, I spoke about Punjab National Bank, that I have started building a lot of position in it. A lot of people that, you know what, you're buying like public sector bank, it is never going to come up, this, that HDFC bank is going to crush it, this, that. Well, PNB and HDFC are not competing against each other. They are not even competing for the same set of customers. Now look at the performance of Punjab National Bank in the last 1 month. Here's the chart for you. So I'm not trying to prove the point that I'm right or I'm wrong. All I'm simply trying to tell you is that you should only buy assets that you have a sense of and you understand how that asset is likely to behave. I would have been completely okay if Punjab National Bank did not move even from one more year from this point. No one, literally no one on earth can predict these stock prices. This brings us to the last point, that the reason why people panic, people just buy on other people's recommendation, people start fretting whenever anything goes down in value, is simply because of the fact that they are overexposed to assets or they don't know how to hedge their risks. So smart investors always hedge their risk. They use the futures and options market to do something called as hedging. I have taken hedges on HDFC Bank. Can I teach you futures and options? The answer is no. It is a more elaborate thing which would require a lot more time. So no, I would not go there. Maybe I'll make some video someday. But just to help you understand a basic hedging strategy, please remember this, that whenever you are investing 1 rupee in an aggressive company would be something like UiPath, Zomato, etc., etc. Buy 2 rupees of defensive stocks, something like ITC, Hindustan Unilever, etc. This is the easiest hedging strategy you can build as a retail investor. And once you have that hedging strategy in place and you are not overexposed to a particular stock, overexposure means that you have 100 rupees to invest, but you have invested all that money in one single company. So that is overexposure. So please split your money, invest in different companies as per your risk appetite. If you follow these 8 specific rules, you are going to make more money than index. I can assure you. I hope you enjoyed the video. Do press the like button and I will see you soon.